Every week on this podcast, we follow the same structure. That's what makes people feel comfortable with coming back again and again, because of course they subscribe, as they should do.
Yes, and the structure starts off with us doing a funny bit.
Usually the funny bit is related to the subject, but in this case it's not.
Because we were not able to come up with anything funny about structured finance.
No, but we came up with a little structure around it. Anyway, here's the funny bit. A sandwich walks into a bar and says, I'd like a pint of Guinness. The bartender says, I'm sorry, we don't serve sandwiches. That's the funny bit. But don't forget to subscribe. You know, the first time I heard that joke, it was actually Bono told it at a U2 concert because the Edge's guitar had broken and he needed to fill in the time. You see, because everything has a structure.
Yes.
Everything has a structure. And that was in 1984.
Wow.
Youch.
That makes you sound older.
But I'm not so old that I can't subscribe to a podcast. I can use little digital machines and devices and subscribe to this on all kinds of different places.
Yes, you can do it on Spotify, on Stitcher, on YouTube, on iTunes, probably a lot more places. And if you do, you won't miss our next week's episode, which is going to be on
hydro bonds.
That sounds exciting.
Come back next week for hydro bonds, but right now, structured finance. So we can do this one very free and easy, unstructured, you might say. Right? So we've got with us Milena Messori, who's head of intermediated finance for micro, small, and medium-sized enterprises, and also likes to climb mountains. Like which mountains?
I climbed a number of them, Mount Ararat being one of them, but also Mont Blanc, Kilimanjaro, and Mount Fuji.
That's pretty much all the big ones, really. You got to go to the Himalayas, but those are all really nice ones.
That's the next step.
They're all ones that we've heard. Mount Fuji, Mount Ararat. That's very biblical. And Mont Blanc.
Exactly.
Wow, that's actually quite dangerous sometimes.
It can be dangerous indeed.
Wow, we're lucky to have you with us.
Nothing happened, thanks God.
And Karen Cannenterre is a structured finance officer here at the European Investment Bank. Nothing quite that dangerous?
No, not at all.
No, but still energetic.
Yes. I need to run to get some steam out of my mind.
So Milena walks up things and you
I just
run around them.
Yes.
Like what kinds of things?
Well, I play tennis, but at a very low level, in the sense that I'm a beginner. I'm really enjoying this, but I have no talent for it. So I'm doing this for pure enjoyment. I also practice yoga. Also, I'm no good at it, but I really enjoy it as well.
How can you be no good at yoga? What do you have to be good at?
Well, you have to be a bit flexible, right?
Oh, okay.
So this is not one of my attributes.
Okay.
But that, as my yoga teacher says, that's the meditation. Yeah. You just, it's all about the practice, right? Well, let's go into structured finance. Let's
smooth.
talk about, was that? Yes,
that was very smooth, yes. I like that.
Absolutely. Well, much like Karen and her sports, we're doing the podcast because we really enjoy it.
Exactly.
Not necessarily because we're so good at it, but that's what makes us lovable, isn't that right, Allar? What is structured finance?
Structured finance, I would define it as a sector of finance which has become more and more important. I would say, when I was studying for my MBA already at that time, which is quite some time ago, we were talking about structured finance. So it has become popular, I would say, in the mid-'80s. But then it has acquired a bad connotation because of what happened in the mid-2000s and the financial crisis in 2007, 2008. What is structured finance? I would say is a way for issuers, so for borrowers, to raise liquidity by issuing financial instruments that are a little bit more sophisticated than the usual conventional debt. And it offers issuers the possibility to offload assets from their balance sheet and offload risk to investors. And it offers investors the opportunity of diversifying the risk by diversifying the financial assets that they can have access to.
So if a company just issues a bond, that's not structured. That's unstructured finance?
A bond issuance is not a structured finance per se. It depends in the sense of how do you issue it. Is it just a unitranche bond, or is it going to be more structured? And when it's more structured is because the issuer itself is repackaging its assets according to risk, and then it's selling to investors different tiers of assets that have in common as the same level of risk.
Well, this all started, you mentioned in the 1980s. That was with this idea of securitization.
Yes.
Is that right?
Securitization is part of structured finance.
But what is securitization?
Securitization is the possibility of an issuer to create a financial instrument where the issuer is repackaging its assets and selling them to investors. And normally it's done by financial intermediaries, but we as EIB, we're a little bit front runner in the sense that we have also created internally something that is not very common in the market, because normally securitization is for very granular portfolios. And it's normally used, for example, for mortgage-backed securities. In our case, EIB has realized that there are needs in the market because SMEs and mid-caps are not sufficiently able to access the capital markets. Capital markets in general in Europe are less developed than elsewhere. So what the EIB has done is to look at new way of structured finance transaction with non-granular securitization. So the granularity is, if you want, reduced, which means is a little bit more difficult to find in the market because it's still very risky. You don't get the same diversification of risk that you get with granular portfolios. And this is where the EIB has been quite innovative, and we have done already a couple of transactions, and we are expected to do more going forward.
So the granular would be a lot of mortgages packaged together. So there would be a lot of different risks in one sort of a product that is being provided to the investors, right? And
Correct.
the non-granular one would be, more different companies packaged together.
Like a handful of companies that are issuing bonds, and we are buying notes that are issued by a special purpose vehicle, which has in its balance sheet the mini bonds issued by the companies.
Okay.
But obviously you understand, one thing is to have in front of you a handful of assets, like 5-10 assets, and one thing is to have 100 assets. The diversification is such that we are obviously looking at very different levels of risk.
Okay.
Because if one defaults, it's very likely that the whole structure will be affected. While if you have a structure where there are, 50, 60, 80, 100 of mini bonds, for example, then if one or two defaults, the impact on the whole structure is much lower.
Let's really try and break it down, because you mentioned the 1980s. The first securitizations were, I think I'm correct in saying, with asset-backed securities, mortgages. Karen, how did that really work? What is, as Milena is saying, being repackaged?
Okay, so the idea initially was for banks to be able to offload sovereign mortgages that they had on their balance sheet so that they could free up resources and maybe lend some more to other for other mortgages or other purposes, so SME, corporate lending, whatever they needed at the time. On the side of the investors, it was a way for them to gain exposure to these mortgages, which are mostly held by banks. But typically mortgages are supposed to be fairly safe lending.
Mm-hmm.
So if, for example, we have an institutional investor such as an insurance company and they wanted to invest their cash in something that they felt was safe, they could invest in those mortgages. Now, the idea also was that you could also attract different kind of investors with different kind of risk appetite by having those structured finance, let's say ABS, which would have different tranches, and each tranche would have a risk profile. So, for example, for a pension fund, they would invest in the safest tranche, which would be, let's say, AAA. Whereas a hedge fund, which would try to get a lot of returns, they would invest in the riskiest tranche, which creates more yield for them. So the coupon that this tranche would be paying would be higher. The benefit for, let's say, the consumers or would be that there would be mortgages available more or less for everybody. So those who have who have a high risk profile, so people who are unemployed or in short-term employment or have a bad credit score, they still could find financing for the right price.
The ABS that you mentioned, that's the asset-backed securities, yes? And so the way that the bank would do this is that the bank would create a new structure, a special purpose vehicle, and would sell these mortgages into this structure, and then that structure would issue bonds, and they would be sold to the investors.
This SPV, as you said, would issue notes. Those notes would have different, let's say it's called Series A, Series B, Series C, whatever you want to call it. The names change, but the principle is always the same. Each of the compartments or the tranche has a different risk profile. And so the people who would buy different tranche have a different profile as an investor. But the idea was that you would be able to cover a bigger part of the market, because normally banks, if they are only limited to, if they follow their own risk appetite, they would only lend to the people who have the safest risk profile. But because they would be able to take on board those risky loans and then sell them to the market, partially or fully, the idea is that everybody would be able to get financing for a competitive price. I'm not saying that the people who have a high risk profile would be able to secure very good terms, but at least they would be able to get financing in the first place.
So it's really taking something that you couldn't invest in and turning it into a security which you can then buy and sell like a stock or a bond.
Correct. It's a capital market instrument in that sense.
And the way this played into the financial crisis was that a lot of investors didn't really know what was in those tranches, right?
Correct.
And so with a lot of these different mortgages in those tranches, people did they not look into what's behind what's in those tranches, or was it not made clear to them by the banks, or what was the reason for that?
They were mostly relying on the rating of the tranche, which was usually performed by rating agencies. And it could be argued that the standards of due diligence of the rating agencies at the time was not high enough. So they themselves have no clue what was in that tranche. And of course, they would give it a very good rating, whereas the asset actually was not that good. So to some extent, it can be argued that some investors got fooled or relied too much on those ratings.
And this is why, Milena, you say that structured finance got kind of a bad name during that time because of those kinds of deals, right?
But back then we were talking about, if you want, an inflationary bubble. So it's a completely different situation currently, and we shouldn't just leave this bad connotation with structured finance, because structured finance still can provide liquidity to borrowers that otherwise would not be able to satisfy their very peculiar and unique cash flows needs.
Mm-hmm.
So structured finance offers this flexibility that normally a standard debt instrument would not be able to offer. So it's still very important, especially to develop capital markets. And capital markets is very important in Europe because, as we know, it's not very developed. Banks are currently also not lending to SMEs and mid-caps. And this is where an institution like the EIB can really make a difference.
You mentioned that one of the structures that we do is brings together less granular assets, companies into one structure. Can you give us an example of how we do that and what kind of companies we package together? What do we package them together based on? Is it also based on ratings, or how do we decide which ones to put together?
Normally we try to put together companies that are quite similar in terms of turnover, in terms of number of employees.
But they can't be competitors, right? That would be weird.
What we have done so far, for example, where in structures where the companies were coming from very different industries. We have recently finalized a transaction in Italy, and I can tell you that the number of industry that were covered by this structure was quite varied. Also in terms of regions in Italy. So we tend to give certain requirements that the companies have to fulfill because we rely on their ability to ultimately repay their bonds. Because the notes that we buy are linked to the bonds that the companies are issuing. So if the companies are not able to repay, obviously then we suffer as lender.
Sure, but so for the investors, it wouldn't be an investment into a specific industry or not into a specific region. It would just be into a type of company or a size of a company. Or
normally it's mid caps, generally it's mid caps. But it can also be sector specific. We have done that as well. We have also closed a transaction with water companies in Italy. So it very much depends on the needs of the market. But currently what we are seeing is that there is a need for financing from various sectors, various industries. So the more diversified the basket is, the better it is for us as investors because we reduce our risk.
The water companies that you mentioned in Italy, that was called the hydro bond.
The hydro bond,
which
exactly.
we have. Our next podcast is about the hydro bond. So our listeners will be able to check back next week and find out all about Italians and what's coming through their pipes and out of their faucets. But the other thing that you're describing is called a basket bond.
It's basket bond, yes. And it's as well, it was also in Italy. And the reason why we are targeting Italy is because, not because I'm Italian, but because Italy has a quite developed legislation in terms of securitization and also mini bonds issuance. So it's a good starting point for us in order to pilot these novel instruments and then possibly expand them to other countries in Europe.
One of the things that I've heard a lot of talk about working here at the European Investment Bank is the first loss piece. Now, you were talking, Karen, about risk profile and so on. What's the first loss piece?
So essentially, that's the tranche that would take the first losses, quite literally. So the idea is that of a pass-through, let's say it's a back-to-back. So for example, if you take a basket of, let's say, 100 companies, and company number 1 defaults, then it will have an immediate impact on the ABS, which is supposed to mirror the repayment flows, the cash flows from the bonds into the notes. So essentially, what they will do there will be sort of a waterfall. So there's a priority in payments. And first, the senior investors, so those who benefit from the best rated tranche, will get paid first. And last will be those who have the lowest rated tranche, which is usually called the equity tranche or the first loss. And these are the investors that would take the hit from the first losses that you will see within the assets, so being sort of this basket of companies, of issuers that you see. So the first loss is basically literally what it is. The name says what it is. It's the tranche that is supposed to absorb the first losses up until a certain level. And then once this tranche is fully wiped out, then we move on to the second tranche, the second loss, essentially.
Getting the first loss piece or buying the first loss piece, does that mean you get paid more for the risk you're taking? Or in some cases, does someone actually want to be the one that loses the money?
It happens that we have third parties that would buy the first loss. So they tend to be hedge funds. And I mean, they are really after yield returns. If they want to boost up the returns and they have the risk appetite for it, it can happen that they would be the investors in that kind of first loss piece. Usually what we ask is that the bank that is sort of packaging this whole transaction, that they retain part of the risk, because they have to put their money where their mouth is. So if they're selling this to the market, they have to be sure that the risk profile or the structure is healthy enough for them to retain some risk. So we ask them to retain part of the first loss.
And I've seen sometimes that first loss piece is used for a grant from the EU or something like that, and they're expecting to lose it. They just want other people to invest in something which otherwise they wouldn't have invested in.
So in that context, that would be the EU taking money that was, let's say, for example, previously used for grants. So grants, basically, you give the money and you don't expect to get it back at any point in time. So they would use the same pot of money, but invest it in a different way. So they would take this subordinated position, meaning that they would take the risk, most of the risk, so that they can attract other investors who would benefit from sort of this protection to join and finance projects which are of interest for example, the European Commission or the EU. Mm-hmm. So that's the way it works. I think the interest of this use of the money, of public money, is that in the first loss, you may or may not lose the whole amount of money, as opposed to a grant. The grant, you give it away and you know for sure that you will never get it back. So there's an interest for the EU, for example, for the Commission to invest to provide first losses, because they may or may not get the money back, but at least they attract the crowd in other investors to go alongside them. So it's a bit more efficient.
That's one of the things that the EU, that the Commission means when they talk about using more financial instruments in the next financial framework.
Absolutely.
But if I may, I mean, in addition to what Karen mentioned, so that the first loss piece is provided either by entities like the European Commission or the banks themselves that are arranging and originating the securitization. In the case of our basket bond, it was actually provided by the companies themselves. So the companies themselves, the 10 companies that are participating in the basket bond, decided to leave money aside, cash aside, to cover for the losses of everyone else. So it's quite innovative in the sense that there was a mutualization of risk among the 10 companies that participated in the basket bond. And this is, again, something quite innovative in the industry.
You mentioned financial instruments. Are all these things that we're talking about, because they're structured, are they all synthetic financial instruments? What's a synthetic financial instrument? And can I wear it? That's the real question.
Well, you use the word synthetic when there is not a true sale attached to it. So it's you're not actually selling. For example, a bank, when they do securitization, is because they sell part of their assets to an SPV, a special purpose vehicle, which is bankruptcy remote from the bank, the commercial bank that is doing the securitization. In the case of a synthetic securitization, there is not such a sale of assets. So the assets remains in the balance sheet of the financial intermediary, but they are, if you want, ring-fenced. So they are identified, and they are not, put in a different framework.
So there's just simply a legal contract between the investors and the bank that regulates what's ring-fenced and what's not.
Exactly. Okay. Yes.
So to answer my question, I can't wear them.
You cannot.
Oh,
no.
okay.
No.
What other types of structured finance are there? What other ones are frequently used? We talked about asset-backed securities and basically securitization. Is that all of it, or are there other kinds of structured finance or finance structures that we should be familiar with?
Well, okay. Securitization by itself is a term that can encompass, a broad range of instruments, because it depends on the assets that you're looking at. Mortgage-based, for example, is because the underlying assets are mortgages. We as EIB, we are also promoting other structures, like, for example, debt funds, private debt funds. Again, this is always in the scope of developing the capital markets and developing structures that are non-bank intermediated. So they don't go through banks, but they are nevertheless providing liquidity to borrowers. How this is done through either lending platforms, or fund managers that, instead of providing what is normally, typical of funds, so private equity, investing in equity, they lend to the final beneficiaries, the borrowers. And this is, again, something that the EIB is now starting to do. Obviously, we have our subsidiary, the European Investment Fund, that has been doing this for years. And now the EIB is also entering in this space, because we realize that there is need in the market for this kind of instruments. And a debt fund by itself it becomes structured finance if, again, it is linked to tranches. So if the risk is tranched, so that investors are taking either more risk, like first loss pieces, or in between, like mezzanine tranches, or senior tranches, obviously the less risky.
And this also serves the purpose of credit enhancement, which is another concept of, or another aspect of structured finance, right? To make the credit worthiness of a structure more suitable for a investor with a certain risk appetite.
Correct. And by providing a first loss piece, normally you do provide credit enhancement, because the structure itself becomes more appealing to investors that otherwise would not have been able to access this kind of risk.
But from a point of view of a company, why is the existence of a debt fund more better for them than bank financing?
Well, because normally a debt fund will require the full repayment of the debt that is provided, not according to a standard amortized schedule, but, for example, at final maturity. So the company that is growing and needs cash to grow will not have to face these periodical payment of capital and interest, but can also just repay the interest and pay the capital at maturity. So these are instruments that provide more flexibility to companies, that address the needs of companies that are either growing, expanding, they don't have yet the assets that they can put as security. So it's a way of creating capital markets and fostering the economy.
Well, I'm always impressed by how smart the people are who come on our podcast.
And how well structured they are, I think.
Oh, yes. But in this case, it's an issue that I've heard about for a long time. I've read little snippets about it. I've realized how important it is. But actually now I feel like I pretty much understand it, which probably means it's time for us to stop the podcast here before I get confused again.
Yes, let's not make it any more complicated than it already sounds.
Milena, Karen, thank you so much.
Thank you.
According to the regular structure of this podcast, this is the time where we ask you to subscribe.
Yes, you can do that on Stitcher, on iTunes, on YouTube, on Spotify. And also, this is the next part of the structure is we tell you to get back to us on Twitter. I'm at Allar Tankler, ALLARTANKLER.
I'm at EIBMatt, EIBMATT. And we've reached the point in the structure where we say, now, here's the closing music.